everybody. Thanks for joining us today for another Wealth Press market analysis. I'm here with Lance Ippolito from the Future of Money. Lance, how are you doing today?
Pretty good despite this market acting up today.
Yeah, so give me an overview. What's the market doing in a nutshell?
So yesterday we had the case of we wrapped up March, so we had some in my opinion excuses saying end of the month rebalancing um, for portfolio managers, but really after hours we started to see the S&P sell off, and it's really spilled into today, April 1st. While what's really shocking me is small caps. More importantly, the Russell 2000 or the IWM ETF, we're down about 5.5% today compared to some of the other indexes like the Dow and the Nasdaq, which are down about 2 to 3%. So those small caps and those financials are really leading the way lower, which in my opinion is very bearish. And then you have transports also taking a hit today.
Mm-hmm. Okay, so is this, in your opinion, the market basically saying, "Well, thanks for the floor on the market, Fed, but we still don't have a high degree of confidence in the future of the economy, so we're going to keep selling." Is that basically what we can interpret this as?
I really think, we could talk for hours about the Fed and injecting liquidity in the market and them doing whatever it takes. And, they talked about buying ETFs. It's starting to look, if you really look at the last like 30 minutes of the day, you'll have the market spike up. And, you know, who's buying? Is it the Fed? Is it some unknown buyer? We don't know, but there's no liquidity in the market. Which is a major concern. Uh, there's no volume. There's no support at these prices. We could talk about the mortgage-backed securities and everything like that. How that market, is completely imploding. But um, I trade mostly options. And when I see that there's no liquidity in the options market, meaning A, there's no volume, and then B, the bid ask is so wide, even on stocks that are very, very popular, trading millions of shares a day, unless you're really trading like the S&P or Apple, Microsoft, Facebook, those very widely held names and ETFs, liquidity's gone. And this is a major concern. So therefore, when the markets go lower, there's nothing there to prop them back up unless it's a short-term bounce, whether it's news, whether it's headline news, whether it's the Fed coming in with a new statement of liquidity. In my opinion, it's getting very, very concerning here.
Hmm. Yeah. Okay. So, what's the opportunity from the options perspective then?
So puts became very expensive a couple weeks ago when we had the VIX spike. Put prices were just outrageous. They were very elevated. What's happened, the market has rallied a little bit, or we could call it stabilized a bit. But the VIX is really, really coming down. Even when you have the S&P down 2% on some days, you've had the VIX red too, which is shocking. Um, so option prices have become cheaper to the downside, or put prices or insurance has become cheaper. So in my opinion, when you have these big green up days, whether it be short-term news, some kind of positive headline, it's a very good opportunity for you to load up on puts, or if you're a stock trader shorting stock, you're getting opportunities because once we go lower, we kind of just drag lower continuously. And traders that I'm talking to, and even Jeffrey Gunlock, the Bond King, came out and it looks like a majority of folks are looking for a test of the March lows again in the S&P.
Hmm. Do you think that it's potentially got a lot lower to fall if the economic fallout that is sort of already taken, call it 25 to 50% off of the expectations for Q1 reporting? Do you think that there's a attitude of let's wait and see how bad Q1 actually looks before we decide to moisten our lips and stick some powder in our muskets?
I, I think we've had data numbers come out of China, like China PMI, which are just complete Pinocchio, we'll call him. Um, I think you're seeing retailers saw like 90+% year over year decline. Obviously, with malls being closed and such. Uh, what scares me is I don't know if we're going to interpret bad numbers as good news for stocks, or if bad numbers actually mean markets go lower. It's kind of like when was and Yellen and Bernanke were head of the Fed, and every time we had negative news, uh, the stock market would go up because they just figured, oh, we'll just continue printing money. I wonder what we're going to do as we start having these economic numbers come out with the effect of the coronavirus. If we're going to take bad numbers as a bullish signal because the Fed is going to do more, or more stimulus because that's what the market seems to like, or if the market's going to interpret really bad numbers like high employment as, oh man, the S&P is trading at 2,500, we should be trading at 2,000. That's I think that's wait and see. But judging by today and just the rallies that we've had over the past week or so, it seems to be like there's no real buying in the market. There's really no confidence in stocks because you have to figure what was propping the stock market up. It was buybacks, right? Um, Companies could get away with their financial engineering and they get rewarded. Crazy PE ratios. Now they can't do that anymore. So we're going to see the good companies excel, kind of like what we've seen in Microsoft recently as the only Dow stock that was up in Q1, and we're going to see bad companies really get punished, and I think we'll see more of that.
Yeah. Further to the idea that the buybacks are over, and therefore, arguably, the earnings growth, which was completely a fabrication of cheap free money, is now over as well. I mean, if you were to look at all of that and say, well, in the best case scenario, earnings could be expected to be more or less flat. In a worst case scenario, earnings are going to plunge, especially from the service industry, which is
Right.
70% of the US economy. So, I mean, again, I'm just curious, is there a trade here?
you know, the easy move is gone. I'll be completely clear with that. That first swoosh down, starting to buy puts and shorting the market in mid February, that easy money's gone. Now you're going to have uh, very volatile. Even if you're buying gold, if you're buying bonds, if you're buying puts, thinking the market's going to go lower, you're going to have up days and down days in whatever positions you have. Um, what I think is you really need to find a sector that is holding up despite everything going on in the world. So, like, for example, I'm a big video game fan right here. Do I play tons of video games? No. But there's three names that I'm looking at that have held up very, very well while the markets have declined. And they are Take Two Interactive, that's TTWO. They're the video game makers of the popular Grand Theft Auto series, which apparently they're coming out with a new series very soon. And they have many Hollywood actors in that. Um, Activision Blizzard, they actually just got upgraded today. ATVI, they're the makers of Call of Duty, a very popular video game, and esports too, in the esport world where they live stream on Twitch, and Mixer, I believe, is the other outlet. And then EA, Electronic Arts, they're the maker of not only the sports series, which obviously has died down like your Madden NBA, but the very popular game Apex Legends, which is basically a Fortnite battle royal game. And the user growth on that is just absolutely insane, with many of the YouTube, Twitch, and Mixer esport players playing it. And again, these stocks have held up really well. You have to figure if people are out of work, if kids are out of school, what are they doing? They're probably playing video games at home, right? So those three names have really caught my attention, and from a valuation point of view, they're priced pretty good right here.
I see. So it's pretty much a case of a specialized shopping where you've just got to kind of go in and expose yourself to names that are responding favorably to coronavirus.
Exactly. If you're going out saying, "Hey, I think Intel's a good buy here. I think Apple's a good buy here." In my opinion, you're kind of just guessing, because what if the Nasdaq takes another 10% move lower? Intel and Apple are going to probably move down 10 to 12 to 14%, just because they make up such a large part of the Nasdaq. Rather, if you have a sector that's really not correlated with the overall market, I think that's where you want to focus on.
Sure. Okay, so let's, for the sake of argument, Lance, let's talk about the idea that this is way beyond a recession. This is going to be a major economic depression where the economies of all nations contract substantially by double-digit percentage points. How does an investor sort of take a position against that long view that the market still hasn't priced in where this is going? Like, let's assume we're going to see Dow below 10,000, S&P 1,000. What's the game there?
Oof. In a perfect world, you'd have metals, your gold names, your silver names, and you'd have bonds, and the yen, the Japanese yen, which you can play FXY, which is the yen ETF if you don't trade currency pairs or futures. In the perfect world, they would go to the moon. Um, are we living in a perfect world and a perfect correlation? No. So if you're dead set that this market is just going to get absolutely destroyed, you can look at buying puts, um, especially again when we have these short-term pops. Um, and when you're looking to buy puts, the one thing I just want to focus on is when you buy options or when you buy put options, they have an expiration. So give yourself time for this to work out. Do I think the whole world's going to collapse in the next 2 weeks? No. But could it happen in the next 8 weeks? We really start seeing that downside of the Dow or the S&P? Yes. Um, so I like, if you really do have that opinion and you really do think this is not over and we're going to see massive downside, look for put options. You can do the QQQ, the SPY, the diamonds, the Dow, IWM, the Russell 2000. Look at them about at least 2 to 3 months out in time. So you're going to pay a little bit higher premium because they're a little bit longer dated than, let's say, the weekly options or the short dated options. But when markets go down, they tend to go down fast, aggressive. And therefore, the price of options, especially if you're buying put options, the volatility is going to soar higher. And then you're right on direction because you're buying puts thinking that stock or that index or the market is going to go lower. So that's how you can really capitalize if you don't want to go and say, well, I'm going to buy GLD, or I'm going to buy the Nugget, or I'm going to buy Barrick Gold or some gold miner, which gold's been reacting odd on certain days. Um, so that really just gives you that, hey, S&P is going to move lower, buy and put options.
Sure, sure. Vis-a-vis the price of gold, which, the first day that the Fed announced its major $2 trillion bailout package, um, on top of the $560 billion a day it was buying in agency-backed mortgage securities, gold shot higher. Went, let's see, intraday, I think it was 1440 to just under 1700, and since then it's exhibited what it has been doing for the last, call it 8 years, 10 years, is that in an environment where the news should be bullish for gold does not really perform that well because the same interests that are painting the tape in the major markets are the same interests that are driving gold lower in the futures market, because a robust bull market in gold would certainly cause alarm for US dollar denominated investors.
Right. And we've had, the government come out and say, we want a strong dollar. We want a strong dollar. Right. So
Yeah.
I think it's going to get to a point if we do make another steep decline in the overall equity markets where you're just going to have gold just tear to the upside. There'll be no more resistance, so to speak. It's just we haven't seen that day, but we have seen that parabolic move in bonds. Or you look at the TLT ETF, that it did have that parabolic move and it did come down. Um, I think the Fed has lost control, just my opinion, and they're running out of ammo on what they can do, and that's what's scary.
Sure. So, I mean, the very worst case scenario that I can imagine is reminiscent of the 80s when when interest rates for homeowners were in some cases above 20%
Right.
as a result of the fact that nobody wanted to lend money because the economy was so uncertain. If we're going into a period where the economy is not just uncertain, but it's most visibly, demonstrably heading a lot lower, and the Fed is unable to induce banks to lend because everybody everybody and their dog has become a much higher credit risk. Therefore, interest rates spike despite what the Fed
Fed
tries
wants.
to get. Then then what?
You've already seen that too recently. People are thinking, oh, well, my mortgage rates are going to go lower and lower, but they actually haven't recently. They've really stabilized, if not ticked a little higher, which, goes back to your point. It is going to be very, very scary. And then, especially if you look at the housing market, which I know up in Canada and Vancouver, Montreal, and then even where I'm at here in Tampa, South Florida, the housing market has boomed so much over the past few years. Um, and, people have taken leverage upon leverage because interest rates have been historically low to buy houses. If you start having home prices decline combined with higher um, mortgage rates, that right there, that's a disaster waiting to happen.
Yeah. Well, we've already seen in Toronto, Canada's largest city, in the downtown core, there's a three-tower project that is mid-construction of a luxury development in the downtown core that just entered receivership yesterday, creditor protection yesterday.
Oh, wow.
And so, the the detached home market for the higher end remains a little bit stronger and robust. I'm seeing lots of sold signs in the nicer neighborhoods, but in the outlying areas, it's really ground to a halt. And for things like condos, where people are maybe where they be having a second home outside of their main home, that just seems to have ground to a complete halt. And so that indicates, in no uncertain terms, that prices must fall. And if prices must fall, then that's going to have a sucking effect on the valuations of a lot of mortgage or a lot of homes that are being serviced by mortgages. And so you got that double whammy, as you say, with falling home prices and rising interest rates. There are going to be a lot of people on the street, no matter how much money the Fed or
Right.
any other central bank prints.
Yeah, if it's very scary because the amount of leverage, and I know you see it up in Canada, that the people have taken out on their homes based on what they can get and what interest rates were. And if these people can no longer pay their mortgage, or if they're stuck with a $500,000 home that is now worth 300,000, I really don't want to see it, but it, the road we're going down right now, uh, it does not look that clear, so to speak. There's a lot of things that can go wrong, and we're starting to see some of those cracks happen. And like you said, the Fed, I think they try to do too much too quick and act too quick, and now they're really just running out of bullets. That's what scares me. The Fed seems to be very, very controlled and working with our government, which we all know the Fed is independent. Wink, wink. Uh, that we're really not seeing what's best for longer term growth, but trying to put a band aid on on the situation that we have.
Lance, that's a great, insightful commentary as usual. We'll come back to you next week at the roundtable. Thanks for joining me today.
Thank you, James. I appreciate it. Chat with you soon.